Hello, everybody. Thank fuck it's Friday. Morning, here, mate.
Good morning, Ryan. You could have said that in a nicer way, couldn't you? We're on air. It's a public show. It's free, and the whole world is watching it.
Yeah, I'm hosting the show. I'll say what I want, mate.
Okay.
It's Friday. It's been that sort of week. One of those weeks we look forward to for ages, and then you get to the end of it and can't wait to see the back of it.
Yeah, that's true. That's true.
But we love it. We enjoy it. That's what we're all here for. That weeks like this, and we're not finished yet. We've got the big NFP coming, and don't forget it's double bubble Canadian jobs as well. So a little bit of extra spice there for you loony lovers. Right, let's get stuck in. No saying good morning to Stel because he's still boating around the Greek islands. All right for some again. Maybe we'll see him on Monday. Depends. You never know.
Whether he finds his way back.
Yeah, he might get lost and end up staying out for another 3 weeks. But no one here is jealous at all. Right. Let's go. Let's go. It's Friday. Come on, back yourself up, Ryan. Right. China. The PBOC were out supposedly saying that they're going to strengthen the flexibility of the yuan FX rate. Yet another comment on what they're doing there. You may remember at the beginning of the week they had similar comments out saying they will improve market orientated floating FX rate system. So they're still working on keeping the exchange rate flexible, part of their mandate. Dollar yuan has been a bit all over the shop on the Fed on rumours, of which we've had more regarding COVID zero policy. The rumours this time were that they may end the suspension of flights where there's COVID situation. That was all out this morning. Again, let's get it onto a little closer chart. That saw dollar yuan coming off yet again, but then we got a semi-denial from the foreign ministry saying that they weren't aware of such measures coming into play. So that turned around. Then we got an expert, or an ex-government disease expert, let's call him that, saying that substantive changes to the zero COVID policy will be happening in the next 5 to 6 months. Now, pinch of salt, obviously, an ex-expert or ex-government expert, so one of those former people, and he was at a Citibank conference. So make of that what you will, whether that's a bit of book talking going on there. But I think we're in the situation now where we're getting to the point of no smoke without fire. These comments keep coming around, these rumours keep coming around. They're not being flatly denied in the first instance, but then they're flatly denied a while later. You may remember the earlier rumours this week, we did get a full big denial saying that they were going to adhere to the zero COVID policies. So it's still two-way trading in this one. But as I say, I think we're getting to the point there's no smoke without fire. These rumours keep coming up and the comments keep coming up. So it may just be a matter of time, but how long before that happens, we don't know. Japan and China are having a meeting. Xi's meeting Kishida, apparently mid-November. A lot of leaders meeting Xi at the moment. We've got Germany's Scholz over there talking nicely about all stuff over there. And funny enough, I think it was Airbus signed a large borrowing deal with the Chinese authorities, helped along, no doubt, by Scholz. So there's lots of people getting their back scratched. Also had a lot of ECB members out again as well. And what's been striking me the most is Lagarde is seeming to be turning far more hawkish than she has been of late. She's been out at least 3 times since yesterday. Yesterday, she said a mild recession won't stop the ECB hiking. Then later on, she said CPI is far too high and we have to take action. And then she added to that, we must deliver on the mandate, no matter what. So very strong comments there. Even this morning, she was out. If I can find it, we must not and will not let high inflation become entrenched. So in my opinion, she is turning far more hawkish on the rhetoric. Not that it means much for euro dollar at the moment, but I think there's potentially an exercise going on to maybe lift rate expectations a bit higher than where they are now, maybe getting that terminal rate up. ECB's Kazakhs came out and said it's impossible to identify where the terminal rate is right now. So I think there is a little bit of an exercise going on here from Lagarde, but she obviously faces others in the governing council. Centino is one of those who's a little more dovish. He said the ECB has definitely front loaded and that it's difficult to engineer a shallow recession. So a little bit more cautious there. What are you making of Lagarde at the moment, Kay? Is she turning hawkish, or am I just making out?
No. The wording is a little more hawkish than she used to be. But then, is it to put the market on guard, or I'm really not sure, to be honest, about her, because we know she's not a hawk, but yeah, it's undeniable. Perhaps her tone is changing a little bit just to try and slowly prepare the market for that higher rate. Still, yeah, I'm really not sure what to think about what she's saying right now, but it does have a bit of an effect on the euro, but not too much. This morning, it's rather about dollar management positions, it seems.
Yeah, and I'm going to talk about central banks in a moment in a slightly different slant, because I think there's something going on that we need to be aware of. But part of that is central banks giving, setting market expectations. At the moment for the ECB, we're pricing a 50 pip hike in December at 90% chance. The other side is a 25 pip hike. So we've gone from 75 50s to 50s 25s. Maybe she's thinking that she needs to get those expectations a little bit higher up, maybe towards a 75 in December, just to keep the momentum going rather than slowing down. And this really brings me over to the central banks, because we had the Bank of England out yesterday, and Kay will know this. Bailey has done his usual, which is deliver something hawkish, follow up with something dovish. But to me, it was quite surprising how dovish they all were yesterday, and that got me questioning why be so dovish. And it's the same question I ask of the Fed and Powell, why be so hawkish? So let's go through some of the answers with Bailey, then I'll get into what I'm thinking right now. So Bailey, they kicked off basically saying that rates are going to go up, likely less than what the current market is pricing, and that rates to go to a lower peak than the 5.2% that was being priced by markets. Now, there's a bit of a kicker in there, is that said that there has been a UK premium on rates, and we are seeing that unwind. But even among all that, he then comes along and says, well, there's substantial upside risks to the CPI path. Then he countered that, saying we should not increase rates too far. Then a bit later on after that, he said, we may have the largest upside risk in inflation forecasts in MPC history. So here we have inflation over 10%. We've got the biggest risks to inflation on the upside the MPC has ever seen. And yet he's being dovish. So why is he being so dovish? And that's coming after the Bank of England delivered their biggest hike in over 30 years, 0.75%. So why are they being so dovish? And in the same breath, why is Powell being extra hawkish? Why was he extra hawkish at the FOMC? Here is a country that we've seen the housing market dropping back. We've seen the main indicators dropping back, the ISMs, the PMIs, you name it, they've been dropping back. inflation has been dropping back. 3 lower prints on the trot, although I can see there's been 2 higher cores on the trot. But when you look at the data, when you look at the fundamentals, is there anything really showing in the numbers that we've seen that would make Powell be more hawkish? In my opinion, I don't agree there is. The same for the Bank of England. Why be so dovish when you're still pointing out the extra risks? So what I'm thinking for both central banks is that they're pushing the rhetoric into areas where they're not likely to deliver, or maybe over deliver or under deliver. So in the case of the Fed, he said that rates might need to go higher. The ceiling might need to go higher than the market expects. I don't think it means he feels they're going to get there, but what is he doing? He's delivering the message, because the message right now is more important than the actions, because he knows at the moment there's an element in the market that are, let's call them the pivoters, that are ready to step in and stand in his way. And why is it important he fights them? It's important he fights them because they are potentially stopping the transmission of his policy, or Fed's policy, by keeping rates contained. So every time there's a pivot call, every time there's bad data, we see yields drop. That's bad for the Fed because they want rates up. And they don't want to let negativity get entrenched into their message, which is one of credibility. They need to fight inflation, do whatever it takes, get rates up. That's their sole goal. So if there's an element in the market that's stopping that, they need to fight that. So the talk becomes more important than the actions. So personally, I think they may get up to their 5% level. If the data is all around is staying on its current path, maybe inflation keeps coming lower, I think 5% is their limit. But I can see them saying that they'll go higher to fight the pivoters, because it's fine saying we're going higher and then 6 months down the line, okay, we don't need to go as high now because the market's gone our way. But it was the talk that got the market to the place it wanted to go. On the opposite side, what has been facing the UK? We know we had all this problem with rates running higher due to the mini budget, all that pressure that came in on finances. And we can see that there in the UK 2 years. Let's put it on that there, you know, running all the way up to 5%. That caused a lot of problems in the UK. Mortgage rates jumping up. The whole mortgage market paused for a day or two. No one could get a mortgage because they had to reassess rates and push rates up. And, you know, now we're seeing people getting 5% rates on their mortgage where they were getting, you know, 2.5%. So there's and then we saw what happened in the pension firms. So this was a market opposite to the Fed. This was players in the market pushing UK rates higher than they needed to go. So how do you counter that? Well, you don't be as hawkish as you need to be. So we've hiked 75 pips and given a really dovish message. And look what that's done to rates, brought rates down. So it's taken the pressure out. And he said, Bailey, about the premium, it's taken more of that premium out. So as I say, on one side of the Atlantic, we've got a market who are trying to stop rates rising so high. And on the other side, we've got the BOE who are trying to stop rates rising so high. I think that the BOE will at minimum need to hike rates to 5%. There's too much inflation in the pipe. There's too much more inflation coming. So they're trying to undersell it at the moment purely because of higher rates are affecting the UK more. And that's important because it becomes a case of do as I do, not do as I say. So I think now we're in a situation where the more hawkish the Fed are, the more I'm looking to fight that, because I don't think they're going to get as hawkish as they're going to be. The same for the Bank of England. The more dovish they are, the more I think they're not going to be as dovish in reality, and rates are still going to go higher. And that's going to give us differences to trade, because we're going to be trading the differences in expectations there. So anyway, that's my thought on central banks, just in general. Kay, you know, you can come in with your thoughts. I know I spoke for quite a bit there, quite a bit on the table.
Yeah, I like your analysis on the Bank of England. That could be that could be actually a very good message to convey, to take the sting out of the immediate interest rate push and pain. I'm a bit less convinced about the one over in the States, because I rather think that, and there was some really interesting question that Powell tried to avoid, on that the markets were still very positive and really pointing at the equity markets and the S&P for sure, and he was trying to avoid it, but as the question got asked afterwards, he went even more hawkish, because for as long as something doesn't break, I think they will continue to go on, because they have the political support to raise rates. So I'm only half convinced about the analysis about the Fed, but I do subscribe to your analysis completely on the Bank of England, which would be a bit of a change, because I think Bailey is one of the worst central bankers this world has ever seen. But if that were to be the aim of what he did yesterday, he was pretty clever. And actually, we have seen, okay, I mean, some pairs and sterling is weaker than before we started the day yesterday, but the Bailey weakness has been reversed. The Bailey press conference weakness has been reversed. So now we are back to post statement levels. But yeah, it could be a real good message. On the Fed side, I'm a little less. I think they're still in. Some of it may be part of their rhetoric right now, because they can push on, because the markets are not derailing. Okay, the 2-year, the very short term is pricing in higher terminal rates, but if we see the long end, the 10s, 30s, 20s, they have rallied on the back of FOMC, but are now back to much more sensible levels. Only like we rallied about 20-25 BPs on the 10s after the FOMC, and now we given already 10 or so back of it. So that signals that the market is I don't think they're trying to fight the Fed, but they see the higher the Fed will go, the more the risk is for a recession afterwards. But actually, the fact of the longer end not really shooting to uncomfortable levels that actually gives them, and the S&P holding up, that actually gives them ammunition to just continue to go, because the system is not broken yet. You see what I mean? And I think as long as the system doesn't really break, they can go on and put interest rates at levels where and that's perhaps already in the back of their mind, where they could comfortably bring them back lower to more neutral levels later. So yeah, there is of course an element of pushing back against pivot callers, but yeah, I think it's more a case of like, as long as things don't break, let's continue. And that is going to bring us into today's NFPs, because it could be a sign that something is starting to break. So
yeah.
But perhaps he delivered a message, and I still, this one sentence still resounds in my mind. When he started to hike, is that he said something, some pain may be taken. And for now, of course, rates are going higher, and mortgage payers are feeling the sting. But the financial system, the rate system, the bond market is not, the longer end bond market is not broken. Yes, they've done a lot of swing, and it for the time being, it should be a painful experience, because there's so much inversion in the curve, but it's not yet broken. And
yeah,
if something would be broken, the stock markets would start to collapse, right?
Yeah, exactly. And
because then everything would go the same way. The bond market would go down, stock markets would go down, and ultimately the dollar would actually go down as well. But it's not broken yet. And for the
Yeah,
time being, they're clearly signaling that the dollar is not their problem, it's the outside world's problem.
yeah, exactly. And yeah, I just want to reiterate, I'm not saying that the Fed are at the top. I'm not saying the US economy is going to crash and burn. But you know, one of the reasons we do this show is to give a bit more light on the fundamentals and more of a running commentary. And so, you know, everything we look at, when you're trading the fundamentals like I do, you keep that running totally in your head. How are things are looking? The US isn't crashing and burning yet. That may still happen, but the signals are that it's coming lower. Recession might be likely. There's still things that need to tip over, like the jobs market. So while we're seeing some negative effects in the economy, doesn't mean they can't turn around. Doesn't mean 3 prints of lower CPI and the next print isn't above 10%. Not at all. But you look at the evidence that's in front of us, and for that basis, that's why my view is that I think they'll struggle to actually get rates above their current ceiling, despite what they may talk, unless the data says that's what they need to do, and that would mean a big turnaround. But as far as the Bank of England goes, I think there's far more chance they will have to hike more than they're telling us, than the Fed is of getting to their higher ceiling, if you like. So yeah, I'm not predicting the US economy to crash and burn just yet. But that's just why. And as I say, when you're trading the fundamentals, this is what you look at. What do all these numbers, data points mean for the central bank? Where does it bring these little changes? And as I say, the Bank of England is maybe doing something that isn't following the fundamentals. The Fed is maybe saying something that isn't following the fundamentals, taking it out of sync slightly with those fundamentals. And that's where you pick up the little clues, because that's where you potentially get your trading opportunities when you can start to trade, get in the beginning of the real big trend changes. So, you know, just to put it in trading terms, I'm still happy to be bearish the dollar, though I'm taking a bit more of a cautious approach after Powell. You know, you can't ignore what he said. But if he says rates are going to 5.25% ceiling, but the next two CPI prints are negative and CPI is dropping back to 6%, you've got to ask the question: why are you hiking that high if you're seeing a trend lower in inflation? That's where you need to look for the trades and get in the longer term stuff, because that's, if it continues, that's where you get the big moves. So that's why we look at all this stuff, and I hope the flow show has given you some of that insight to that as well. And ask the question. You know, I know we talk about the data every day and it's just numbers on the screen and whatever, and the comments, but you have to put those in the context of your trading. So if you're unsure how to do that, if you're in our chat room, come and talk to us. If you're not in our chat room, just asking the questions here. You know, that's what we want to do. So there's a question from Michael. Is it advantageous for the US to keep a stronger currency for longer to write off inflation or other reasons? That's a good question, because if you remember when Trump was in, a strong dollar was a hot topic for what it did, because obviously you've got the import-export sums to deal with. You know, the stronger your currency, the worse it is for one side. The weaker your currency, the better it is for the other side. You know, that sort of thing. So it is an issue, but at the moment they're just blasting through because it's all about inflation. And yeah, the stronger currency does help that, in the same way a weak economy, a weaker yen is affecting inflation in Japan. And the same for the other countries. The weaker your currency, the more the inflation build-up is, because it's costing you more to buy stuff. If you're buying stuff in dollars like energy, fine, there's your inflation. So it does offset somewhat, but it's always a two-sided coin. For some it's negative, for others it's positive, and it's just where the ratio is between those as to whether it's a problem or not. For the US, it's not so much of a problem, but for other countries it is. So that's why they're happy to let the dollar strengthen. And as Kay said, it's the rest of the world's problem, not theirs. Let's see, there was another question here. Surab, if I've got your name right, I hope so. Is everyone on hold till NFP before taking any positions? I think a lot of people are. I certainly am. I've got a couple of positions running, more 2 long-termers and 1 gold long that I'm just going to be managing over the NFP. Before we get into that, Kay, you got any other headlines, or do you want to have a look at a couple of charts before we get into the NFP stuff?
Well, I mean, you can talk about NFP and then we look at the charts. Well, in the news overnight, the only thing that really struck my mind in regards to the Japanese yen is that Japanese government next year is going to issue a record amount of debt. And thinking about the Bank of Japan in Kuroda, well, it's going to be a problem for his successor. How are they going to manage that? I think it's really a ridiculously big amount. I forgot the real amount, but I think it's something like 63 trillion yen or so.
Yeah.
In that zone, it's going to be an absolutely ridiculous amount. So I don't know how they are going to keep managing all of it. But if and when, or if the Bank of Japan keeps it low, it's going to be another proof that they are just printing money to support the government, right?
Yeah.
And in that
Did you
case,
see
that's going to add oil to the fire for a possibly weaker yen again next year, in my opinion, if they keep the rates low.
Yeah. Did you see that news from the GPIF?
Yeah, the
their
losses.
numbers,
Yeah, well,
yeah. Is that something?
right?
Is that something that the Bank of Japan will take notice of?
Yeah, but what do you do with that?
Yeah, that's the question. But
yeah, what do you do with it? If you're in Japanese bonds and Japanese equities, you tell them to. The thing is, that's the nature of a pension fund, right? The nature of a pension fund is to be in bonds and equities, and that's what we've seen on the SNB, because they are not really a central bank. They are more like a hedge fund or pension fund. So and they took like a gigantic hit as well in the first 9 months of the year. It's the nature of what they have, right? I was actually it's 5.4 trillion yen they lost.
Yeah,
it's about $50 billion, right? In or 40 or so, 35-40 billion dollars. I don't know how much they handle, but it's an absolutely gigantic thing. I think they are the second one after the Norwegian fund, right? In size. Yeah, it's something that we have seen in the past, but I don't know what the Bank of Japan can do about it, because the nature of their investments is always going to be, if the bond market performs well, they will make money. But if the bond market and at the same time the equity markets underperform, they're always going to lose money. Yeah, it's an ongoing problem.
But what about the transmission of those profits through to the people who have got their pensions and investments with the GPIF? If they're losing money on top of inflation rising, on top of income problems, that's a problem at ground level, isn't it?
Yeah, but that's been a problem for the GPIF in the past 15 years, really.
That's true. That's true.
They made a very big amount of money over the pandemic, though.
Yeah,
they made huge over the pandemic. But now, yeah, there's a big give back. But if you want to know what it means, ask BlackRock, because BlackRock, they are also handling a part of GPIF's money, as they do with any money in the world, even for central banks. BlackRock is handling a bit of that. Yeah, I don't know what the Bank of Japan can do about it. There's not a lot to support. They do in a way, because they're buying ETFs. Yeah, they're buying ETFs and REITs, so they do in a way already support them. But I don't know what else they can do about it.
Yeah, and just in case you people weren't aware, the GPIF is one of the Japanese whales, as they're called, a big pension company, big fund, and when they go into markets, they move markets. So beginning of the year, just before the beginning of the new fiscal year, we usually get a lot of comments where they're going to be investing, whether they're going to be hedging it, the FX side, and that sort of thing. It can drive a lot of flows that we see in the early part of the year because they are big market movers. So that's why it's important to keep an eye on those sort of guys. Right, so just before we get into the NFP stuff and some of the prices, just looking at some of the data yesterday as well. Challenger job cuts were up for the second month on the trot. This is a report, small report, that shows firms' intentions to lay off workers. Doesn't mean those layoffs actually come through as actual job losses, but it's an intention. So like we've heard from Twitter, expecting to lay off 50% of their staff, and there's a number on that. Doesn't mean they'll all go, but that sort of number will go in the layoffs. So this has been I think it was the highest since April 2021, I think, somewhere like that. But it's the second time on the trot it's been higher. So again, something to feed into the jobs market. Jobless claims was not really much going on in those. The 4-week average down a tiny bit. That seems to be going a bit sideways at the moment. We've got the US PMIs, the services components, the S&P Global further into contraction there. And then the ISM, which was a little bit all over the place. We saw business activity coming down a bit, but still looking fairly strong. New orders dipping back again. But then we got the prices component. So the inflation component was up to 70.7. And the employment index went into contraction. So the Fed can't seem to get everything going the same way for them. So although jobs may look to be weakening, the inflation metrics is picking up according to that. So again, a bit two-way on that data point there. Right, let's get into the FOMC, the NFP today. We're expecting around about 200K. Reuters is looking for 200K, Bloomberg looking for 195K. Unemployment rate 3.6%. Participation rate is the number we're going to need to keep an eye on because that has a big effect potentially on the unemployment rate. So a perfect storm of good news would be a decent NFP print, and I think as long as we're above the 150 mark, things are still looking good, although you could say that we're on a bit of a trend lower. Let's see if the chart here can show that. We've got to zoom in a bit. Let's try it out. So we're on a little bit of a downward trend. Take these big spikes out the picture, and the trend is gradually edging lower. So I think if we stay above 150, the market's not going to be too bothered. If we start dipping under 150, 100, maybe even negative prints, then obviously we're going to have problems because then we're seeing the jobs market tipping over. But the participation rate is important because, as I say, you could get a good NFP number and let's say the unemployment rate fall into 3.4%. Now, if that comes with a participation rate going higher, that means more people coming in and looking for jobs, not so much getting jobs, but coming into the market to look for jobs. That would be a good report. So a higher participation rate, good NFP, lower unemployment rate is the golden ticket, if you like. Now, what makes it more negative would be something like the participation rate dropping, okay, and that brings down the unemployment rate as well, but then we get maybe a bad NFP. So that's, you're looking on the real negative side. So you've really got to judge the three numbers in themselves: the headline, the unemployment rate, and then whether the participation rate has affected that unemployment rate at all, because it can make it less or more negative. From that, look at the wages numbers, because obviously that's the inflationary component. Pretty much running still below inflation. So real wages are still in the negative. So if this number starts kicking up, getting back above the fives, creeping up higher sixes, that sort of thing, then there's further potential inflationary pressure to come for the US. And that means we might see the CPI numbers start to turn around from their dips that we're seeing. As for picking a number, it's a lottery. It's always a lottery. That's why we love the NFP. This number could come in up 500 as easy as it could come in minus 200. That's what makes it so exciting. When I was on the live floor, this was the biggest number of the month. Pits were packed shoulder to shoulder, hard to breathe. You couldn't move your arms. Everyone deathly silent 10 seconds before the buzzer went and the numbers dropped, and then pandemonium. So it's always an exciting number to watch for this one. So coming in, Kate, what are you expecting? Shall I give my number first, or shall I let you put a number out?
The White House said to expect 150K in the next few reports. So
That's right, yeah.
I don't know if it was a gentle hint as Trump used to do, but they're going for 150K. We know, and we've been saying it for a while, that sooner or later those numbers should start to drop. And I don't know when the lag is going to be absorbed, but it could be any report from now. I'm gonna go with a number around 120K. Let's put it at. Let's stick my neck out. 120.
Yeah, I'm gonna go 175, and I nearly nailed it last month. By the way, I said 262 last month, and it was 263.
Really? Wow.
Yeah. Go check the tweets, mate. Simon's just said
you won your weight in respect from everybody.
Yeah. No, there wasn't an NFP competition this month. Pretty much because I forgot, and it's been a fairly busy week. So that sort of hit the sidelines. So apologies for that. I will make sure that it's up and running for next month, most definitely, and we'll try and chuck some extra prizes on in that. But no, this one we can play for fun in the chat room and here on the Flow Show. So yeah, I'm going 175K. Let me write it down. What did you say, Kate? 125.
120.
120. I'm going 175. Okay. Come on, guys. Put your guesses in the comments there.
All right.
And we'll have a little look at those. 135 says Michael. Oh, here we go. They're all coming out now. So what do you think, Kate? Yeah, you said we're waiting for this lag to kick in.
Yeah, that's what I'm kind of waiting to see when it's going to kick in, because I do expect lower numbers, but in the global scheme of things, and I'm going back to an interview that I had, and I think it was with Jim Bianco on the Trader Summit, who said, because my opinion about NFP and jobs growth was always about we need to stay above 150K 200 line, but he said that statisticians and other people are now looking at numbers which are much lower, around the 60-70K mark. So anything above 60-70K should mean jobs growth. And I was a little surprised about it, but it's just something that has changed over the years. Of course, it changes with the global unemployment environment and stuff. But if we take that into account, any number that would come out 100 or above, let's say, should keep the Fed just on course, and yeah, should keep them just keeping their path. Of course, as you say, there's other stuff. We always have to look at the components as well, and we are going to have the Canadians as well, where those components between how shall I say, part and full timers are also important for the viability of any move in the Canadian dollar.
Yeah, the revolving door.
Sorry?
The revolving door, as I like to call it.
Yeah. So, okay, do you want me to have a quick look at a few things, or do you want to?
Yeah, go ahead, mate, and then I'll have a quick look at a few charts because we haven't looked at the prices much.
Yeah, I'm gonna let
While you're setting up, what I want to say about the NFP today.
Can you stop sharing?
Yeah, I'm doing that now. It's important in terms of what we've had from the FOMC. Okay, this hawkish twist. If we do get really strong numbers, then we're probably going to get another leg higher in the dollar in yields. We may just be seeing a bit of a pause at the moment. So if you're thinking of trying to find a dollar top, and you think, well, we're not seeing any more highs in the dollar right now, don't get sucked into a false sense of security. If we get a big NFP, then we're going to see the dollar rally higher again and yields rush higher. Conversely, if it's a really bad report, then maybe we are going to see a bit of a top in the dollar. But it's a bit of a binary event, and probably a lot more focus on it than normal, given what we've had from the FOMC. And over to you, Kay.
Yeah, I fully agree. It's going to be a binary event. I think so too. And not so much for people, callers or whatever, but if really the job report starts to the job market starts to slow down, that's going to ring the bells, and then we might very quickly drop into that pain level market, right? And I can see the dollar giving back quite a bit of its shine. First of all, I wanted to show this silver because there's something going on here, and I've highlighted it with those 3 circles. Sorry, since the middle of October, we had those recovery jumps. We tried 3 times under 19 bucks in silver, and it's really holding. And I wasn't sure, but then and I'm kind of missed a bit of the occasion. But if we start to see a return in the dollar without going into massive negative economic data, because it's an industrial metal, so it could suffer a bit from that. But this one looks to be ready to me. Ready to take off. It's brewing. It's really brewing. We are holding. We've had several attempts to hold this first trend line, but it's really something is brewing here. So unless we get a massively good report, which would really put the dollar on the front foot again, and then we might see a dip coming back here, a final rush into the dollar or so, then we could see things here. But if we get only, I think only a mildly negative, as I would call it, report, I think this one could really start to take off. I'm going to let you cover gold because you are in position, but I'm really paying very, very, very close attention to what's going to happen in silver today. And I am still long-term long, but I haven't added anything. But I think whatever happens, I'll try here. If we see a mild dollar buying bias on the afternoon, but if we start to see dollar selling, I think this is the one that could really take off. And if we get a confirmation through this 2021 figure 15, which has always been a bit of a zone, I think there's a possibility that this goes over time back to perhaps a 24 zone or so. Just saying that one. Then the other one, I've got small same feeling on the yen that I had going into the FOMC. That is, if we get a bad report, dollar yen could really start to move lower, and the yen crosses suffer a bit. Although we are seeing seeing a bit of how shall I say, correction here. I think people are trying to manage their positions ahead of the FOMC. If in turn we are having a really good report, the market is going, in my opinion, be a bit afraid of what's happening in the with the MOF and Bank of Japan. So this could be a bit of a laggard compared to other dollars, which could in turn put again pressure on the euro, on the yen pairs. One that I'm watching And unfortunately, Lagarde has got a little bit more hawkish this morning. But one that is firmly on my radar is the euro yen here, around 145. If we get I don't know, a spike above, but we can't hold it into the end of the week, this is one that I'm going to really pay close attention to, because showing signs of top building and coming back off. The other one is this sterling yen. No, I've done the same mistake as yesterday. It's the one just below K. The one is this sterling yen. It really came off a lot, and with the dovish slant of Bank of England, again, I'll be looking at a decent recovery here, perhaps around 167 or so. I'm going to have a very close look at this one, because I think we may see it come off over time a bit more. On the euro, things are still pretty clear. We are it's now trading back above 98. We are having trouble to stay around this 97.5 for now. People are a bit worried about what may happen on the NFP, so we are going back to a more neutral here. If we close the week back above 98.70, I think there's room to get back up to parity or perhaps above on a week report. If in turn it's a very good report, I think 97.5 may be toast, and going to have a look at this 96.60, 96.60, 75 again. Again, and I've been saying it, this may have been a low because it got triggered on that famous Asian day when the sterling got absolutely trashed. This may have been a low. So for the dollar to get an end of year blast, we have to get through here, and I'm not sure this market is ready to take it through here. So this is going to be a big level, but I think on the day, if we already get back to 96.5 on a very good report, that should be a pretty decent move. Cable line, yeah, cable. 111.5, 112.85, and I think this one here is going to be important. If we get back through 113.25.40, then this thing has probably room to move back up to 115. If in turn we're getting a very good report, watch the 111.5. It really held well yesterday. If it goes back down, some more around 110.75, 110, low 110s is going to be interesting. But then the big level for this one, to me, is low 109s. 109 figure and a quarter on the cable. This is where things are going to have to hold for the sterling to prevent from reprinting those lows. It's a really big level, in my opinion, this one. Quick one on the CAD before we get the report. We're trying to get back into this channel, which is actually happened. That's around 136.55. I think that's going to be the level to watch for a close above or below at the end of the day. If we're below, why not get a revisit for starters of the 135, where it really bounced off nicely last time. And if that wouldn't be enough, we can actually go back down to 133.5. But that will depend on the double whammy between the US and the Canadian labor report. If in turn we get a decent close above this 135.5 and 136.5, adding 136.85 to it, we may revisit the highs. That's for the dollar Canada. And another one which I'm keeping a close eye on. This has been really dumping over the past sessions, thanks to higher oil as well, but also Canada data not really dropping very fast. And this one I'm keeping a really close eye on. So the closest one here is 133.35. Top side again 134, and I think the 134 has always been a measure of what's going on in this cross. So this is going to be my close that I'm watching, above or below 134. See, I'm still not a very happy euro buyer. I'd rather be inclined to see a move above and perhaps a failure to get into something. If we are above and close above, then I'm just going to let it go for what it is. If we're below, I may try to accompany this for a move back down to perhaps sub 133. And finally, which I've been looking for a very long time now, perhaps a move into the 132s. Euro, yeah, dollar China, interesting one. Very interesting, dollar China, because these close here, and we are we trading down there already? Yeah, 722. 720, 722 is the level of that we should watch, but we are now trying to get out of this channel. The issue is that PBOC has fixed 725.5, and I've always said, like, I mean, I'm watching this PBOC fixing very closely. So I had a tiny running over the past few days, did a nice bit of jobbing, but then I closed it just below the PBOC fix today. Well, I mean, the close of the day is going to be important. Get above this 723 again, and ideally above the PBOC fixing 725.5, and this could rally again. If in turn we start to break below 1920, this could actually drop quite a bit further, perhaps even back to 7 on hopium about possible reopenings. The other one, no change. We are holding those low 19s for now on the Euromex, but we'll see what happens. For the Euromex to go lower, I think for now we need a mildly good report on the NFP to keep risk on the positive side. I did cover a bit yesterday ahead of this level, so now I'm running smaller short even than my core, and I'm waiting to see if I need to add or not again. And then really the final one, dollar MEX. This red line that we have since 2017 is now really being tested, and we're trading below. So watch out if we get a slightly bearish dollar one without really being very bad, because otherwise risk could actually hold dollar MEX up. But if we get a mildly negative one, I think dollar MEX has perhaps room to go lower. And back over to you.
Thank you very much. Yeah, just as I've typed in the comments there, I'm going to do a prize draw because we didn't do the NFP. So it's going to be out of all you folks in the room. Don't worry about picking NFP numbers or anything like that. I'm just going to, with the help of the K-Meister, going to pick someone out at random, and you'll get a free month on the ForexAnalytix platform. So we'll do that right at the end, and then don't disappear, because I may need your details, but we'll get it there one way or another. Just to have a quick look at some of the bits and pieces I've been looking at. I know we had a question on Aussie dollar just a bit earlier. Yeah, as Kay said, I think we're probably going to see a little bit of repositioning into the number, which is only just over an hour away now. Just as the market, you know, takes a bit of risk off the table and whatnot. The main thing that I picked up following the FOMC, as we were talking about, is I look at the wider levels, look at where the price may run into trouble, where the stretch points are. For Aussie dollar, I was looking this area here, 62.70, and those in the room yesterday will know I put those levels on the charts in the room. Didn't even get close down to the 62 handle, which is another big level. On the other side, couldn't even get near the 65.20 area. So for me, we're still in the range, and again, we'll see what the data does today. If the data is really good, then that reinforces Powell's new hawkish message. Can we break this level? If we can't break this level, you know where we're at. If we can break this level, can we break this level? If we get down there, test it, can't break it, you know what to do. Same with dollar yen. Highlighted this 148, 40.50 area. It's banging its head on it again. Couldn't break it over the Fed. This looks to be a bit of a ceiling for dollar yen. I'm not going to say that the MOF BOJ are in there because they're not picking numbers, but forget about intervention. That's where the market is saying we're not going above for now. So that's your marker for a strong NFP. Get up there and test it. can't break it, you know what to do. Same on the downside. I'm not really interested in unless we're going to move down to the big 145. But watch these prior lows. You know, 145.70 down to the low 145s. This is going to be your first area on any big weak news from the NFP, big bad news. Look at that level 145 after that. The same exercise for the NFP as you should be doing as we did for the FOMC. Go to the wider charts, find the wider levels, find the big strong range edges. If the price has to move somewhere, it's got to break those. If it can't, we stay in range and we ping pong around. The only other trade I'm in at the moment is gold. As I was talking about yesterday, I traded this off this support area. This is now a third support level here. We've come in big strong level off the fib, which was the August 20. I've forgotten what it was now. Off there, which was the August 2018. That's where the real swing up happened. So that fib number has been super special. I am still running a sell stop underneath it because as strong as the level looks, that means if we do get a break, it's likely to, it could be quite volatile. So it could give you decent rewards trying the short side over there. For my long position, I'm going to look for a move potentially up to this big zone here. Again, if we can't bust it, that's where I'll look to take some profit. Then start perhaps bringing my stop right up behind to lock in the rest, see where we go from there. Angela, great breakout yesterday. Love that setup. Looking for a move up to 88. Let's have a quick look at that. Yep, certainly is. Got above that sticky point, 87s, 87.20s. You know, it's a bit of a wide area there. Some people had you know, their techers up to sort of 30s. I'm still want to play this from the long side, but not at these levels. I still think we're just mooching around. But if you're long and looking for that 88, you know, get up into these high 87s. You got to be looking to see if that's where it's going to run into trouble. So good luck for your trade there. Right, let's have the draw then. Kay, I need your help with this just to make it fair and square.
What do you want me to do?
What I want you to do, I want you to stand on one leg, put your left hand on your head, and then pick a number between 1 and 55. Any number you like.
I'm not watching the screen, so I'm going to say.
Oh, I've got it on. Oh, don't put it there. Woo!
I'm going to say 37.
37. Okay, 37. Right. Give me a second. I now need to count down. 1, 2, 3. 37 is Peter Tasu, if I've got that name right. So you are the, I'll bring that back down. You are the 37th person that I've taken off the participation list. Peter Tasu, you have won a free month on the ForexAnalytix platform. What I will do is, I think we should have your email address from your registration. Let me just tip that in there so you know. I think we have your email address from the registration. So I'll get that from the guys in the back end. Failing that, if you want to go to the Forex Flow website, you can go to our contact page, forexflow.live, go to our contact page, and you can send me your details via that, and then we can get in contact with you and set you all up. So well done there, Peter. Thanks for coming. Everyone else, I will get the NFP competition running up next month, I promise. And why don't we have one of these draws now and again as we go along? Bit of fun at ForexAnalytix expense. Don't tell Stelius. But screw him, he's on his boat, so I might as well spend some of their money. Don't worry about that. Anyway, thank you, everybody. I hope you've had a good week. Please trade safely over the NFP. Thank you as always for coming to the Flow Show. Thank you very much for your support for this. I hope we're doing right by you. Have a great weekend. Thank you, Kate, for all your input as well this week, and many beers to be shared this weekend, no doubt. Have a great weekend all.
Have a safe NFP trading and have a great weekend, everybody.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.